All right, so we talked about accounts receivable. Let's talk about note receivable. Why would you want to obtain a note receivable? What does it give you more of? Why would you want to do this rather than an accounts receivable? Well, a couple of instances. First of all, you might have a big ticket item that is sold in return for this notes receivable, and you want to create a little more formal legal arrangement with your debtor, and so you have them sign off agreeing to pay the debt. Usually there's installment payments monthly. Usually these are more long-term sort of obligations than simply accounts receivable, which are paid within 30 days. So, I mean, you really want to get a little more legal commitment from the debtor, and this does that. Not to say that if you don't get paid by somebody who owes you accounts receivable, you can still sue them, because you still have an agreement, you still have a contract, but there's the longer the commitment goes, the higher likelihood of default. So you just want to get a little more legal commitment, and that's what this does. Another instance where you might see a note receivable is when you have loans to other entities or to stockholders or employees, inside people. So you don't see a lot of that, but I mean, you do see some of that. And again, the thing that distinguishes notes receivable from accounts receivable is the fact that these are more long-term, and because they're more long-term, the creditor, the person who is owed the debt, wants to get not only the principal amount paid, but also these notes receivable almost invariably have an interest component to them. And so, for instance, when you're buying a car, you agree to pay monthly payments, and each monthly payment has two components to it: the interest component and the principal component. And during the early life of the note, you're paying mostly interest. About halfway through the note, it changes to where you're paying mostly principal amount. That is what we call amortization of interest. Now, amortizing interest is a little more complicated than what they have here, but for the sake of learning, how do you calculate interest? Well, you simply take the face amount, multiply it by whatever the agreed annual rate is, and then further multiply that by whatever fraction of the annual period you're dealing with in the fact situation. So if you're talking about a 3-month note, $10,000 at 6%, 10,000 times 0.06 times 3/12 or 1/4. So that's the way that would work. So we have an example here. Stridewell Wholesale Shoe Company manufactures athletic shoes that it sells to retailers. On May 1, 2016, the company sold shoes to Harmon Sporting Goods. Stridewell agreed to accept a $700,000 6-month 12% note in payment for the shoes. Interest is payable at maturity. That's a little unrealistic, but let's just go with it. Makes things easier for you. Assume that an interest rate of 12% is appropriate for a note of this type. And so the first thing you're going to do, and again, you are in this situation, Stridewell, the seller who is taking the note, so you're the creditor. You're going to book on May 1st, 2016, a note receivable for $700,000, and you're going to book sales revenue of $700,000, assuming that Harmon has the goods and all that stuff that you have to do for revenue recognition. You're recognizing revenue on May 1, 2016. And so, again, nothing happens until the end of 6 months in this particular situation. Again, that's a little bit unrealistic, but this is what would be called a balloon note, meaning everything is payable at the end of the note period, maturity of the note. And so on November 1st, 6 months later, Stridewell receives $700,000 of cash for the principal amount plus a half year's worth of interest of $42,000. So here, 700,000 times 0.06 times 0.5, which is half a year, equals 42,000 interest revenue. So pretty simple calculation they have here. Certainly not, if this guy was making monthly payments over the 6 months, you would have to do a full-blown amortization of interest and principal, but they've made it pretty simple here. Now, they change up the situation, and what this is meant to show is how you would recognize a certain amount of revenue at the end of an accounting period, even though you'd not been paid. And so here, they change it up to where the note doesn't start May 1st, but it starts August 1st. It's still a 6-month note, but it matures in February 1, I think, August, September, October, November, December, yeah. February 1 of 2017. And so when you get to December 31st, Stridewell is going to have to recognize a certain amount of revenue, accrued revenue, for the 5 months of 2016. And so that's all they're doing here. And so 700,000 times 0.12 times whatever 5 divided into 12 equals $35,000 booked as interest revenue. And of course, the offsetting debit to that is interest receivable. And then on February 1st, you're still going to get $742,000. You've got to recognize interest revenue of $7,000 for the month of January. And of course, you back out your interest receivable and your note receivable. Now, just a word for non-interest bearing note. There really isn't such a thing. So you have to imply a certain amount of interest that would have been charged to figure out what the actual interest rate is. In other words, the face value of the note includes some implied interest. And so this implied interest is built into the note and discounts the face amount and so the discount on the note receivable represents future interest revenue that will be recognized as it's earned over time. This discount on note receivable is shown as a contra revenue account to the note receivable. And so just a simple example here, we've got this $700,000 6-month non-interest bearing note, and they're claiming that there's a 12% discount rate in payment for the shoes. And so same numbers, right? Except you're not recognizing revenue for $700,000. You're considering this interest built into that amount of $42,000. And so your sales revenue is reduced to the difference between $700,000 and $42,000, the discount. So sales revenue in this case is $658,000. And then on November 1st, when this is paid, you back out the contra revenue account, discount on note receivable, and you book a credit for interest revenue, and then you're receiving cash for $700,000 and note receivable of, you're going to back that out for $700,000. Okay? Now I will mention, let's see where this goes. Now they go on to talk about long-term notes receivable and really the non-interest bearing note receivable, because long-term notes receivable, just the regular interest bearing notes receivable, they talk about in, I believe, chapter 14. But just in passing, I'll mention here that when you have a non-interest bearing note receivable that's long-term, not 6 months, but say 5 years or so, 3 years, you've got to build in a present value component. Again, we didn't cover chapter 6, so I'm not really holding you responsible for that, but just so you know. All right, let's look at subsequent valuation of notes receivable. Just like you saw with accounts receivable, management has to keep track of the collectability of these notes receivable. And if it appears as if one or more of these notes receivable are going to become either partially or wholly uncollectible, they have to deal with this. And they have to deal with it beforehand by figuring out what portion of the notes receivable will be uncollectible. And so just like you would have your allowance for doubtful accounts for accounts receivable, you would have something like what you see on page 381, a contra asset account called allowance for note receivable, or here they have allowance for loan losses, or allowance for credit losses is another term used. And so you would probably, do that based upon a percentage, or look at specific loans and try to determine how much of them are going to be uncollectible, and you're going to book a contra asset account. You're going to book a bad loan expense or a bad note receivable expense. That would be your debit, and then allowance for credit losses or loan losses, or whatever you want to call it, allowance for note receivable, something like that. Now you can change up the presentation by just carrying the fair value. And so here they could, instead of having built into the balance sheet this allowance for loan losses, they could just give the net loans as the amount on the balance sheet. Now, many companies use their receivables to help quicken cash flow even more. And so there's a couple of ways that you can do this. One of them would be through what they call secured borrowing, where you would use your receivables as collateral for the borrowing. And the other would just be simply to sell your receivables. That way you get the money in even quicker. And so with secured borrowing, you pledge accounts receivable as collateral for a loan. When you do this, the whole amount of receivables serves as collateral. And that's true regardless of whether the receivable existed at the time of the secured borrowing or any time after. And so it's kind of a rolling pledge against whatever accounts receivable is there at any one time. Now, the company remains responsible for collection of the receivables, not the bank or financial institution from where they get the loan. Now, this arrangement should be described in a disclosure note, but notice that no special accounting treatment is needed. You don't have to mention in your balance sheet that your accounts receivable is encumbered by this secured borrowing or anything like that. It's the secured borrowing simply shows as probably a notes payable, and as long as you disclose it in the notes, tying the secured borrowing to, well, the AR to the secured borrowing, then you're good to go. Now again, you can sell receivables. They can be sold at a gain, usually a loss in my experience, because the person who's buying the receivables is taking a risk. Now, the accounting treatment for the sale of receivables is similar to selling any other asset. You're receiving cash, so you would debit cash. You're going to close the amount of receivables that are being sold, so you credit that, and then there's probably a fee for this, and then whatever the difference is either a gain or a loss. Now, with secured borrowing, the loan amount is almost always less than the receivables that have been assigned for collateral. And that's just the way the banks are. They're always going to want to have more pledged than the amount of their loan, just in case some of those ARs accounts are bad. That way they can collect the whole amount of their loan. How would that work? Well, let's say the company defaults on the loan, and what the bank would do is find out what receivables are out there existing at the time of the default, and they would simply notify the AR customer, whoever owes the AR, they would just notify them that this AR is a pledge for a borrowing, and that they need to pay the bank, not the company who defaulted on the loan. So, just to give you a bigger picture of how that would work. And like I said, the difference provides protection against uncollectible amounts. They always want to be overly secured. Again, the lender usually charges an upfront finance charge in addition to the stated interest, so that you have to consider that in your entry. Now, the collection of receivables, again, can be negotiated. Who's going to collect them? The borrower or the lender? So we have an example here. December 1, 2016, Santa Teresa Glass Company borrows $500,000 from Finance Bank and signs a promissory note, interest at 12%, payable monthly. Company assigned $620,000 of its receivables as collateral for the loan. Finance Bank charges a finance fee equal to 1.5% of the accounts receivable assigned. Okay, so what Santa Teresa Glass Company is going to get is the difference between the $500,000 they're borrowing, and Finance Bank is going to take their finance fee out of that amount. So they're only getting almost $491,000 in cash, with the difference being this finance fee expense. And notice that this percentage is based upon the amount of the AR that's been pledged, not the face value of the note. Continuing on, Santa Teresa will continue to collect the receivables and will record any discounts, sales returns, and bad debt write-offs, but will remit the cash to Finance Bank, usually on a monthly basis. So what they've done here is they've sped up their cash flow by obtaining $490,700 in a loan immediately, and in return, Santa Teresa is going to collect these receivables and turn right around and pay those proceeds to the bank to pay off the loan. So, is that a good idea or a bad idea? Well, I can't really tell you if it is or not. Because, certainly Santa Teresa, since they will collect the receivables, assuming they collect all of them, $620,000, they still get all that as soon as they pay off the loan, of course. But they continue to take the risk of, maybe the accounts receivable is not collectible. So, and it didn't cost them that much. It was a finance fee and some interest. So they, of course, when you have cash flow troubles, this sort of deal may be the difference between existing and not existing. So I can't say if this is a good deal or a bad deal, but obviously management considered it necessary. Now here, what they do is they're changing this up to where Santa Teresa is assigning instead of pledging, okay? So this is a big difference. When you assign receivables rather than pledge them, you're simply going to, between Santa Teresa and the bank, they're simply going to say that, if you default, we can come after your receivables. And so, because of that, you simply book the receivable. Of course, you're going to account for the cash received, $400,000. You're going to back out the receivable. I take that back. This is just all part of the whole deal that they're talking about, the pledging. They threw me off with that assigned business. I mean, it's pretty much the same deal with assignment. All right, so anyway, the bottom line is they collect $400,000 of their receivables. They back out the receivables by crediting them. They debit the cash, and then they're going to pay that over to the finance bank company. So they credit cash, and of course there's an interest component to that, and they're showing 1 month's worth of interest here. So it's obviously 1 month later after the receipt of the loan. So anyway, that's what your accounts look like in all this. But note that you, even with pledging or assignment, you still keep the receivables on your books. Something has to disclose this pledging or assignment in the notes. Notice here that you have in your presentation the disclosure of the assignment or pledging by simply taking the liability, the financing arrangement, and netting it from the accounts receivable assigned. So here, the amount of accounts receivable that have been assigned, and you would probably have to segregate that from other receivables, is $220,000. And then you have, of course, $100,000 remaining on the liability. So the net amount of accounts receivable is $120,000. So we have a question here. Jada Company borrows $100,000 on January 1 from Northeast Bank at 12% interest rate. Jada assigned $140,000 of its accounts receivable as collateral and agreed to pay financing fee of 2% of the accounts receivable assigned. On January 1, Jada's accounting for this transaction will include you're not getting the full amount of cash here. You're borrowing $100,000, but the bank's going to take the financing fee out of that. The financing fee is $140,000 times 2% or $2,800. And so the amount of cash you're going to get back is, or get in the loan, the net proceeds is $97,200. Now you can sell your accounts receivable to what's called a factor. Now you can do this with or without recourse. If you sell your accounts receivable, you're removing the receivables from your accounts and you're going to recognize a gain or loss on the difference. Usually it's a loss because the amount of receivables you're transferring is not going to be the same as what you're going to get as far as cash proceeds. The reason why is because the factor has considered several things. Number one, factoring, in my experience, is probably not a good thing. Not saying it's a bad thing necessarily, but you have to wonder why you would be factoring. I mean, you must have some real cash flow problems, because they're not going to give you anywhere near what your net receivables are, because they're just not going to take that big of a chance. So they're going to charge a factoring fee that's usually pretty high for the privilege of buying these receivables. They're taking an incredible amount of risk. Now, it depends partly on whether or not it's a sale with recourse or without. Now, again, the amount of receivables that's removed is the fair value and any assets acquired or liabilities assumed by the person or party selling the accounts receivable has to be recognized in this transaction as well. We'll talk about that. All right, so you have this financial institution. There are companies who specialize in factoring accounts receivables. They charge a fee, pretty exorbitant in my experience. And in return, the company, for money, the company sells its receivables to these financial institutions, and the financial institution takes over the responsibility for billing and collection of receivables. Now, they talk about securitization. Don't want to spend a whole lot of time on that, but this would be where you set up what they call a special purpose entity, and then you buy all these receivables from all these different companies, and then you wrap them up into some sort of securitized vehicle, such as a bond or commercial paper. Anyway, I don't want to spend a lot of time on that. All right, so here we have some examples of the disclosures that you have to have. And this is on page 384. The top one is factoring, advertising of factoring service. I mean, this kind of tells you, and this is a disclosure for the factoring company. This just kind of tells you what they do. But that would be a typical disclosure note for a factoring company. Now, for one of these special purpose entities, this would be a disclosure note for that type of an operation. But again, I'm not holding you responsible for this securitization program, but I mean, it's the same idea as factoring, in that the company that's buying up the receivables is taking responsibility for collecting them. Like I mentioned, accounts receivable factoring can be done either without recourse to the seller of the receivables or with recourse. And so if it's done without recourse, the buyer of the receivables can't go back to the seller of the receivables and ask for more money if the receivables are uncollectible. So they take full risk in this deal. So we have an example here. Santa Teresa factors its receivables that had a book value of $600,000 to Factor Bank. Transfer was made without recourse under this arrangement. Santa Teresa transfers the $600,000 to Factor, and Factor immediately remits Santa Teresa cash equal to 90% of the factored amount. And so the 10% difference covers their factoring fee and to provide a cushion against potential sales, returns, and allowances. After Factor has collected cash equal to the amount advanced to Santa Teresa plus their factoring fee, Factor remits the excess to Santa Teresa, if any, so that they're still going to get their, okay, they paid 90% of the $600,000. They're still going to get their factoring fee of 4% of $600,000. And anything over, what, $624,000 that they collect will go to Santa Teresa. Again, is this a bad deal? I don't know. Again, management has made the decision that this is a good deal to speed up cash flow that they apparently need. So Santa Teresa books $540,000. Now, the difference between the factoring fee and the amount of, well, the difference between, yeah, how do I want to say this? Okay. The difference between the receivable sold and cash is $60,000, right? Also, and so $540,000 cash, but you're going to reverse back out the accounts receivable, and here you're going to book the what's called receivable from Factor of $26,000, that being the difference between well, let's see. Yeah, they had a 10% to cover, right? Their booking what says here that under this arrangement, Factor provides Santa Teresa with cash up front, beneficial interest in the transferred receivables equal to the fair value of the last 10% of the receivables to be collected, which management estimates to be equal to $50,000 less the 4% factoring fee. So that's where they're getting that receivable from Factor, the difference between the $50,000 and the 4% factoring fee. And so the difference is their loss. Now, notice that the 4% factoring fee has not been taken out of the cash necessarily. Well, I guess it has. This is a little different than what you've normally been taught, in that at some point you've got to recognize this factoring fee. And all it's shown here is that you're receiving less cash, and 10% less cash, and in that 10% is your 4% factoring fee. Interesting. I would think at some point you have to book the factoring fee expense. And so I would take some, I would do what they do here. If you have a problem like this, just book it just exactly like this. But I would think that you would be booking factoring fee expense $24,000. Your receivable from factor, which is the difference between the $50,000 and the factoring fee. And then you would have a loss of $10,000, but that's not what they're saying here. Anyway, we can agree to disagree here. All right, so compare that with factoring with recourse. Here, the seller retains all of the risk of the bad debt. And so the seller guarantees that the buyer will be paid even if some receivables prove to be uncollectible. So the seller retains responsibility for the fact that some of these receivables may not get paid and thus have to be paid by the seller. Now, what's happening here is that since Santa Teresa is retaining the risk, in return, the factoring company charges usually a lower factoring fee. All right, so assume the same facts as the previous illustration, except Santa Teresa sold the receivables with recourse and expects the fair value of the recourse obligation to be $5,000. And so they're estimating what their recourse obligation is going to be. So it's kind of like a warranty liability, right? And so they book the cash, they book the receivable from factor still, they book the recourse liability, and they back out their accounts receivable, and the loss here is simply a plug number, the difference between all of those figures, the debits and the credits. Which of the following is not true about factoring receivables? Well, cash received upon transfers less than the amounts of receivables transferred. That's true. Transfer without recourse means that the transferor bears the risk of the receivables not being collected. That's not true. All right, want to go to transfers of notes receivable. Well, no, I don't. I want to go to this. Transfers of receivables. When can you consider a receivable sold? And so FASB's changed the rules, and essentially it's when the company, the transferor or the seller, has surrendered control over the assets transferred. And so the conditions for determining whether or not a transfer of control has occurred are the following. The transferred assets have been isolated from the transferor, meaning they're beyond the reach of the transferor and the transferor's creditors. And these are all "and" afterwards, so you have to meet all of these. Each transferee has the right to pledge or exchange the assets it received. So the assets, the receivables, are the transferees, so they can do whatever they want with them, including the right to pledge or exchange those assets to somebody else, to a third party. And the transferor does not maintain effective control over the transferred assets. And so again, what they're trying to do is, just like you saw in Chapter 5 with sales, they're just trying to make sure that companies don't recognize a sale before they should. And so if all these conditions are met, then transferor can book this as a sale. So here's a little chart for helping you figure out whether or not you've got a sale. And again, what you do if you pledge receivables, you simply note it. Disclosures. The information that transferors must provide in disclosure include describing the transfer itself, any continued involvement with the transferred assets, if any ongoing risks that the transfer might incur in the future, how the fair values were estimated when recording the transaction, any cash flows occurring between the transferor and the transferee, and how any continuing involvement in the transferred assets will be accounted for on an ongoing basis. Now, just a brief discussion of receivables management. We talked about this some. You can change up your policy on credit sales, and just understand that there are some trade-offs. So you could change variables such as the level of sales. You could change variables such as the nature of the product or service sold, or you could change up your credit and collection policies by, for instance, offering discounts. You're going to get paid sooner when you offer cash discounts, but you're not going to receive as much money. Or you could post longer credit terms. The problem there is a greater risk of default. Sure, you're going to have higher sales probably, but the counter to that is the default. And then, of course, you have your assigning, factoring, and discounting receivables as options. And remember that you've got your two ratios that you might use in determining whether or not your company or another company is managing and collecting their receivables in a timely fashion. So you have your receivables turnover ratio. This tells you how many times receivables are turning over in a year's period. And of course, average collection day takes that number and converts it to the number of days it takes for a company to collect an average receivable. So if receivables turnover ratio is going down, not a good thing. If the average collection period is going up, not a good thing. So just some things to consider.